Waiting for class to arrive. There he is. Hello, Tyler. How you doing?
I'm doing all right, Bob. How you doing?
Good, good. You ready for chapter two, huh?
Yeah, I am. I
Yeah,
actually took this class last year or about a year and a half ago, but I had to drop out because that's when COVID started.
you were in that class with me, right?
Yeah,
I remember you. Yeah, how you been doing?
I'm
Other
doing
than
all
the
right.
pan,
How are you doing?
other than the pan, yeah, that was awful that semester. Um, and it's been terrible since. I think teaching online. I don't particularly like it at all. But good,
Yeah,
good to see.
I was working two jobs and then I lost one of them because of the pandemic.
Yeah,
And yeah, it was just a lot on my plate at that time, and I couldn't really also go to class. Even though I was
yeah,
down to one job, I mean, I had other stuff going on, you know.
but still, the pandemic. Let me just get rid of this. Close the phone off. Yeah, it seems like 100 years ago that class took place, huh? When we were actually in the classroom, and now the faculty is fighting with each other about how to reopen the campus. I hope to be on campus pretty soon. Is it just gonna be me and you, Tyler? Is that possible?
I hope not. I hope other people join.
Yeah, I don't I hope I didn't drive them away because you're here, so we know we're in the. Are you a baseball guy at all? Did I ever bother you with that?
No, I'm not.
Just I got the game on in the background. They're only in, you could appreciate this. They're only in the fourth inning. The score's 10-7. That's a lot of runs in just 4 innings.
That is a lot.
Yep. All right. Well, I tell you what, Tyler, you and me will get going here, and we can chat up old times.
Okay.
Yake.
I'm another East Coast guy, by the way. I'm from do you know Worcester in Massachusetts?
Of course.
Yeah,
Yeah.
I'm from like 10 miles outside of Worcester.
Oh, no kidding.
Yeah.
I didn't know that's where Holy Cross is.
Yeah. And Quincy.
And what?
Quinsigamond?
What's that?
It's another college.
Quinnipiac?
Uh I think it's Quinsigamond is the name
That
of
one.
it.
That one I'm not familiar with. I played baseball against Quinnipiac in 19. Jesus Christ! It was 1970. That's a long time.
Wow.
That was Connecticut. That wasn't Massachusetts. I'm sorry. All right. Well, good to have a near Bostonian with us. All right. Can you see the PowerPoint, Tyler?
Yeah, I can.
Okay. Let's see what we can do here. And hello to the rest of the class. I'm sure you're going to be watching this, if not live on videotape on your favorite channel. Okay. So let's get going here. Let me set this up one more time. Okay. They're talking about what they expect us to learn in this chapter, so we can just go ahead here. We're going to reintroduce you to the T accounts. I don't know if we even got that far the last time we were working with this class. Understanding a business, what activities causes changes on the balance sheet. Any financial transaction practically will do such a thing. We're going to try to understand how specific activities affect balances and how do companies keep track of things appearing on their balance sheet. Not going to worry about all this about objective of financial reporting. Suffice to say, the financial reporting is important to owners of the business and creditors and lenders and possible investors and even the employees. Okay, remember the famous accounting equation: assets equal liabilities plus equity. This is etched in stone. It must always, always be in balance. And going forward in your working lives, if you're ever working in accounting, you're never going to go out of balance. No computer system will let you go out of balance. That was a problem in the old days. But suffice to say, assets equal liabilities plus stockholders' equity. Assets, maybe you have $1 million in assets, but you might have liabilities of 400,000. Liabilities are debts. Liabilities are what we owe to our vendors and our creditors. So 1 million minus 400,000 is going to equal your total equity, which is the net worth of the business. Assets equals liabilities plus stockholders' equity. And then they're showing us an example of a balance sheet here. They're kind of jumping around a little bit in this presentation. Chipotle, we're going to actually do Chipotle. And they're kind of giving you some explanations of what these things are. We know what cash is. A short-term investment, ownership of another company's stocks and bonds, accounts receivable, money due from customers, money payable to us, money we expect to receive from customers. Don't mix it up with accounts payable, which is money we are due to pay to suppliers. So this gives you kind of a little bit of a head start on the different types of accounts. Unrecorded but valuable assets, intangible assets. This thing is jumping around a little bit too much for my taste. Okay. In any business, most of your transactions are external. In other words, you're doing something with another company for the most part. You're paying somebody, you're selling something to somebody, you're buying insurance. An internal event, those are going to be our adjusting journal entries, which you're going to see in a couple of chapters, okay? Accounts are used by companies to accumulate the dollar effect of transactions. You have something called a chart of accounts, and you've got cash and inventory and equipment. You can set up as many of these as you like. And they're just giving you some good examples here. Assets equals liabilities plus stockholders' equity. And then stockholders' equity is impacted by sales, expenses. Sales will increase the equity, expenses automatically reduce the equity, also known as capital, also known as net worth, okay? So this is something for you to maybe look at a little bit later. They're talking about prepaid expenses. We want to get to some transactions here. Apply the transaction model, huh? Principle of transaction. Every transaction has to have two accounts. Two, count them. You must have a debit and a credit. You must have 1, 2. You can have more than 2, but you have to have at least 2. So that's why they call it double entry accounting. And assets equals liabilities plus stockholders' equity. Oh, hi, I'll say hi, Tommy. How you doing? Welcome, Tommy, to the meeting. He's on an iPhone, so he won't be able to share. Balancing the accounting equation. Think in terms of what just happened. What happened? Well, we got the electric bill in the mail. Oh, okay, that's what happened. That means we have a bill to pay. We have to think in terms of classifying each account by asset, liability, or equity, noting cash is an asset, payables are always liabilities. So let's see what we have here. To illustrate the use of transaction analysis, let's look at a few transactions. We're going to do a few transactions using words like plus, minus, and then we're going to get into the world of debits and credits. So let's take a look at some transactions. Chipotle issued 100 shares of stock with a par value of $1 and a market value of 3. The par value of a stock is a meaningless, nominal, required, unimportant number that doesn't really affect anything. The only thing you do with the par value is multiply it by the number of shares, and that becomes your common stock line. So 100 shares times 1 penny is $1. So your common stock is $1. And the difference between that and the 300, we're going to call that additional paid in capital. And we're going to have a whole chapter just on this little section here as we get later in the class. But for now, what happened was Chipotle issued stock and they received $300. That's probably $300 million been truncated, okay? So look at our equation. It's in balance. Assets, 300 equals stockholders' equity of 300. No liabilities yet. They borrowed $2 from the bank. They borrowed $2, huh? Chipotle borrowed $2 from the bank, signing a note to be paid in 3 years. So they borrowed two, and God help us if they really had to borrow just $2. So they borrowed $2 from the local bank, and they are going to pay it later. So what happened? Cash went up because they borrowed the money, and they've made a promise via a note to pay it later. So the liabilities went up, and our accounting equation is still in balance. Still in balance. Three, now Chipotle bought land for 8 million and 34 million in buildings, 10 in equipment. They bought a whole bunch of things, and they paid in cash, and they signed a note for just $1. So what we have here is different accounts. They bought land. That's certainly going to be a separate account to control. Buildings, separate account. New equipment, and intangible assets. Intangible assets are assets you can't see, you can't feel them, but you know they're there, like amortization, patents, copyrights, trademarks, any intellectual property is what we're talking about. So they purchased a whole bunch of these assets, and they paid for it with $54 in cash and chose to take out a note to borrow more money. So now they've borrowed more money. Look at your equation here. We're still in balance. We got assets of 50, was it 54 minus? Yeah, we got assets equaling the liabilities plus the equity. And here they're paying down that note. Remember the dollar they just borrowed? They just borrowed $1. So what happened was the note payable went down. We don't owe that dollar anymore, and cash went down as well. So we're still in balance with the accounting equation. Now, Chipotle was lucky enough to have some money left over. They didn't know what to do with. So they went out and they bought stock. Let's see what they did. They bought stock in another company for $44 in cash. Of this, 9 was in a short-term investment, 35 was in long-term. A short-term investment also is an investment in a stock or a bond or some vehicle that will mature within a year, that will expire within a year. You expect to spend that money within a year. The 35 is long-term. That could go on for years. So here's what we have here. We have cash, 44,000, and of that amount, cash came out of here, 44,000, plus the investment of 44. Okay, simple as that. Cash, we spent 44,000 to buy 44 worth of investments. It's just a swap of one account for another, one asset for another. Chipotle does not pay dividends, but reinvest profits. However, for illustration, let's assume they pay a dividend. If a company pays a dividend, that automatically reduces their stockholders' equity. And it's going to be done through an account called retained earnings. Stockholders' equity consists of different accounts. Common stock. Remember, we said the common stock line is always the par value. The par value times the shares. The additional paid-in capital represents the rest of that contributed capital, which is another word for it, contributed capital. Retained earnings is a portion of equity where we're going to put the income and the dividends. Now, that was a real quick look at some transactions using the expressions up, down, increase, decrease. Now let's get into the guts of the accounting world here. You have something called the general journal. Journal entries, we can call it. A journal entry is the mechanism for updating your general ledger. The general ledger, or the T accounts, it's a record of effects to the balances of each account. Let's get started this way. We go through our process in chapters 2 and 3. We're going to, at the beginning of the period, we're going to analyze transactions. We're going to do this every single day. We're going to record journal entries in the general journal and post them to the general ledger. In other words, you might have 10 different transactions and you're sitting at your computer and you're entering all 10 transactions, but you haven't posted them yet. So you entered them and you look them over and you double checked and you triple checked. And then you hit the button that says post. And then that is what goes right into your general ledger as a permanent record. So we're getting started on during the month, different things. Here we go. Are you ready for the words debit and credit? If you guys took accounting 110, you should be familiar with this already. If not, you just have to catch up, a little bit of catch up, a little bit of catching up. Accounts are said to have a debit or a credit balance, okay? Debit and credit, all it means is left and right. That's all it means, left, right. One is not better than the other. There are no value judgments, debit or credit. The tricky part is that some accounts increase on the debit side and others increase on the credit side. Assets go up with a debit. That's said to be the normal account of an asset. A normal account means the side of the equation, debit or credit, that increases the balance. And there's no other way to teach this except just, keep pushing it at you, doing some of the homework until you know your world of debits and credits. And this is the one advantage the 110 students have coming in, but it's just one advantage that quickly goes away in a couple of weeks, okay? So assets go up with a debit. Here's another way to look at it. Assets are accounts with debit balances. I'm so sorry, guys. Liabilities, credit balances. Liabilities go up with a credit. Stockholders' equity goes up with a credit as well. So let's take a look at our journal entry. Our journal entry. This is the way you get information into your general ledger. Chipotle issued 100 shares of stock. Remember this? At $1 a share. So they got $300 total from the market. Now take a look at the journal entry. You have a debit side and a credit side. The debit side just means left. The credit side just means right. That's all it means. So we have a debit to cash. Cash goes up with a debit. We just increased cash. Common stock, equity, all the equity accounts like additional paid-in capital, retained earnings, they will have a normal credit balance, meaning they are increased with a credit. So there's your journal entry. Debit cash, credit common stock for the dollar, and credit paid-in capital, additional paid-in capital for the difference. So let's take a little bit of a peek here. Here is our journal entry. This is what we just did over here, okay? This is what we just did over here. Notice they added a fourth line, investment by stockholders. Every journal entry you write should have a written explanation, and it should only be a couple of words like that. If you're having trouble writing a clear explanation, it could be your entry is incorrect. And it's also a way for the auditors to look and find out what you were trying to do in the first place. But okay, we wrote this journal entry. Now we hit the button called post. Take a look at your general ledger. The general ledger is simply a fancy T account. See the T account here? That's a T. The balance at the beginning was $186. They're giving us that. So we posted this entry. That 300 is going to show up in your general ledger under cash as an increase of $300. So we debit cash and we bring the balance to 486. We had an increase in common stock of $1, which brought it all the way up to 2. And we had 299 additional paid in capital credit balance. Okay. The T accounts are the general ledger for purposes of what we're doing here. Okay. How do we get the ending balance in an account? Well, we're going to start with the beginning balance and we put in the detail. And it's really just a matter of adding up the debit side, adding up the credit side if there was anything there, and the high man wins. So here we have a beginning balance, which they give us, and each transaction is given a letter or some kind of identification code so we can figure out what happened back and forth. Okay. Put the ending balance on the side of the T account that it represents. In other words, decide if where it would be a positive number. Assets have a debit balance. Liabilities plus equity have a credit normal balance. Take a look at accounts payable. Here, we started off with a balance of $600, and we put in, and we bought some more, so that increased it to 2,100. And then looks like we made some payments. So we started off with 600 plus 21 plus 15 gave us 2,100. And then it looks like we paid off 1,800. So the missing number there would be 1,800. That gets us down to a balance of 300 plus 2,400 plus 2,100 gets us up to 24. Balance would be 21, etc. Yike, we're back on the same entry again with the darn penny stock. It literally is a penny stock, isn't it? Cash. Look at your T account now. The T account. You debit cash, you credit common stock, you credit. All three of these items increased. It's just that you need to understand which ones increased with the debit and which ones increase with a credit. All right. Remember, we borrowed $2 million from somebody? Look at your T account again. Cash went up to with a debit, and it went, and so did notes payable. They went up with a credit. Assets have a debit balance. Assets equals liability plus equity. Therefore, if assets have a debit balance, liabilities and stockholders' equity would have to have a credit balance. So let's take a look here. They didn't give us all these entries to do, but they filled in some entries for us. Now we're kind of at the end of the month, huh? The month is ended, and we have to start preparing some financial statements. The first thing we need to do is figure out the ending balance in all the T accounts, in all the ledger. And the way you do that is you add up both columns and subtract them out, and the high man wins. For example, cash, short-term investments, land, buildings, equipment, intangible assets, long-term assets. These are all assets, so they would have, by definition, a debit balance. And you notice that they do have a debit balance: cash, investments, etc. Assets, debit balance. If you were doing cash and you ended up with a credit balance here, which can happen, it means a couple of things. It could mean that you made a mistake. It could be there's some money that you deposited in the bank, and just haven't entered yet into the cash account. Or it could be you're playing the float the check game where you have $389,000 worth of cash, but you have 400,000 of checks that you've written, and you're hoping to get those checks cashed after you bring in some more money to cover them. Okay, so assets have a debit balance. Liabilities, credit balance, that's going to be your accounts payable, your notes payable. Notes payable current and non-current. Current means 1 year. Current means a debt that you're going to settle within 1 year. And typically notes have a 1 year period where you have to consider it current, and the remainder would be non-current. Maybe the company announced a dividend. So we're going to do that by debiting retained earnings, reducing equity, crediting payable. When you see the word payable, that means a liability, and that means a credit balance. And here are your equity accounts. All of them, you notice, have credit balance. So if we added all these debits up, if we added all these debits in the first two rows rather, and then we added up all these credit balances, they would have to equal, and they will equal. There's no way you're going to go out of balance. Excuse me. Big data, what do we got here? Quick that. Okay, so now we have all the balances. Once we have these balances, now we're in a position where we can prepare some financial statements. And we're going to start with what's called a trial balance. So take a look at this thing called a trial balance. It's simply a listing of the ending balance of every account in your general ledger. And they're listed in the normal order, which is assets, liabilities, stockholders' equity, revenue, and expenses. This is not a report that's going out to the public. No one would be interested in this. This doesn't tell you anything. It tells you nothing. All it tells you is that the debits equal the credits. That's all it does. But it is the starting point. And whether you're a small flower shop on State Street or you're Walmart, you start your closing process with the trial balance. Now, all it tells us, like I said, is that the debits equal the credits, but this thing could be completely wrong. Every number on there could be wrong. The trial balance is not going to tell you that, okay? It's a starting point. So now they're talking about current assets. Current assets. We have current assets and non-current assets. Current assets are those to be turned into cash within a year. Non-current assets are those that are going to last a lot longer. Your current assets are cash, which is the very definition of current, accounts receivable, which is easily converted into cash, inventory. You don't wait a year to sell your inventory, hopefully, or you're in trouble. Those are current assets. You're going to chew them up within a year. Current liabilities are the same thing. What liabilities do we have to pay within a year? Those are called current liabilities. And these are important terms, the current and non-current. They're going to be used in a lot of analyses and a lot of ratios you're going to put together and a lot of metrics. So current assets, current liabilities within a year, non-current or fixed assets and non-current liabilities more than 1 year to resolve, okay? So now we took those entries we did here, and now they're going a little bit ahead of us. What they're showing us now is our new balance sheet for March 31st, 18. So here it is for 17. Here it is for 18. And this is pretty typical. Where did we get the numbers? 389, 333, 49. Where did we get those numbers? We got them from the trial balance. And where did we get the numbers on the trial balance? We got them from the general ledger, from the T accounts. So here are the T accounts, our general ledger. Here is the proof that the debits equal the credits. And at that point, they're just assuming that it's okay. And here they put together a balance sheet. Let's look at a balance sheet. A balance sheet is a representation of the accounting equation. It shows that assets equals liabilities plus equity. A balance sheet is a snapshot. It is a photograph. It represents a microscopic point in time. The balance sheet tells us that as of midnight on March 31st, 2018, just as the clock struck 12, this company had $389 million, and this is in millions. So Chipotle, and these are real numbers, by the way, Chipotle had $389 million in cash. They had some short-term investments. They bought stock in another company. Their customers owed them $49 million. All this is an exact point of time. So the assets total $23.48. And notice that they're broken out into current assets, and then they list non-current assets. Land, building, and equipment. They are the classic long-term assets. Land, buildings, and equipment, they last for years and years. Hopefully get some benefit out of it. And then they have some long-term investments they bought. Maybe they bought a 30-year bond from another company, or they have intangible assets. That would be they bought a patent, they bought a trademark or something. So there's a classification of your assets, and we do the same thing with the liabilities. You've got current liabilities. You see the word payable, you know it is a liability. So you have accounts payable, unearned revenue, which we'll explain in more detail. That simply represents cash you received for work that you've not done yet. Dividends payable, they agreed to pay dividends, income tax. So these are your classic current liabilities. Long-term liabilities could be a note that goes beyond 1 year, a 5-year note, a 10-year note. Assets equals liabilities, total liabilities, and here's your equity. Here's your equity. And we've got proof that 2348 equals 2348. Now, what companies are going to be doing, of course, is they're going to be looking at the differences in these numbers here. Look at cash. Cash more than doubled. They went out and they brought in some more short-term investments, not much change here. And you go through it looking for significant changes. So what I would say, I'd want to know why the cash doubled like that. That's a good looking sign. Accounts payable, a lot of the numbers are pretty much the same. Here's just a look at the balance sheet, just the asset side. I'm sorry, just the asset side. Current assets listed first, then your non-current to get to the total assets. And here's the bottom half of that balance sheet. Accounts payable, unearned revenue, dividends payable, etc. Look at the common stock line. Try to get into your head right now that the common stock line is always going to be the par value times the outstanding shares. That's all you do with the par value. You do nothing else with it. It has nothing to do with the market value. In that problem there, the stock issued to the world was a $1, was a 1 penny par value. That has no meaning at all in terms of the market value. The public valued the stock, though, at $3 a share. And that's what that IPO brought in. Initial public offering, $3. International perspective, we're skipping that. Okay, let's do a little quick analysis. A little quick analysis here. The current ratio. Well, if you take the current assets and divide them by the current liabilities, you're going to get something called the current ratio. And this is something all investors look at. Anybody looking at a company, this is a quick look at their short-term health. In other words, if you have current assets that exceed current liabilities, it means you're in a position to pay off all of your current liabilities and still have some money left over. So in this case here, they took the numbers, I'm assuming, right from our balance sheet, huh? 326, was it 326 and current liabilities 326. They make a liar out of me. They're using different numbers. But Chipotle's at this point had 630 million in current assets, 324 current liabilities. So they have a 1.944 current ratio. Now, what that means is they have $1.94 left over for every dollar that they pay off, or rather 94 cents. In other words, after they pay off all their debt, they would still have 94 cents for every dollar they paid off. So that's almost a 2-to-1 ratio, and that I guess is pretty good. Let's look at what Chipotle's done in the past. Well, let's see. They had 2.9, then it went down to 1.85, went up again a little bit. If you ask me which is better, the higher the better, up to a point. In other words, if you've got a 3-to-1 ratio like here in 15, yeah, that's better. 5-to-1 would be better. 10-to-1 would be better. But if you're getting up that high, you're getting in a position where you're hoarding cash and maybe overlooking opportunities to do something with the money. So, 2-to-1 is probably the area, the sweet spot, I would say. So Chipotle's in about the 1.9 area. And look at their competitors, El Pollo Loco and Fiesta. They have a much less impressive current ratio, but they may be doing things with that money that is driving more profits than Chipotle might be doing. So current assets divided by current liabilities. We're going to talk just a little bit about cash flows as we get toward the end here. Cash flow simply means cash coming in, cash going out. Companies love to increase their cash balance all the time, like we were just saying. You want to understand, though, where the cash is coming from. So when we talk cash flows, we have 3 different types of cash flow activity: operating, investing, and financing. Operating covered in the next chapter, but operating cash flows means what is this operation all about? For example, Coca-Cola. They're in the business of making soda, producing soda, marketing soda, bottling soda, selling soda. Any expenses, cash in, cash out, cash in, involved in that is the operating activities. That's where you want to see positive cash. But maybe they invested in another company. If they did that, it's a negative cash flow. But then they sold that investment, hopefully for a profit. And financing is simply borrowing. So if a company is showing a big increase in cash, but it does not come from operations, that could be a problem. That could be a sign of a problem. Is a cliche, and it's very true. You don't want to invest in a company that is showing profits, but poor operating cash flow. What it means is they're making money, but they're not making it by selling their product. They're making it another way, by maybe selling off some old assets, or they rented out part of the building for some income that has nothing to do with operating. And that's pretty much a quick look at chapter 2. I did not like those slides, to be honest with you. We have different sets here, but that's okay. I think it got the point through okay. So this should help you get going on your homework. What do you think, Tyler? Are you able to keep up with what we were babbling about?
Yeah, this year I definitely am able to follow a little bit better.
Can I tell him your story, me and you?
Yeah, of course.
Yeah, Tyler was in this class with me when the pandemic broke out. So we were on the campus for what, maybe 3 classes or so, Tyler, roughly?
Yeah, it wasn't a lot.
Yeah. And then the pandemic hit, we were all isolated, and students just were losing their jobs. Students had problems at home all of a sudden. So Tyler said, I'm going to take it at a later date. And welcome back, Tyler. How you
Nice.
doing, Andrew? How's Andrew doing? Is Andrew there?
Doing pretty well, man. Doing pretty well, thank you.
Andrew, are you a baseball guy at all?
Not really, no. I'm a soccer fan, so I'm watching the Euros and the
Oh, you're watching the Euro Cup, huh? Who's
oh,
playing
yeah.
right?
Today.
Yeah, what game you watching?
Check out who's playing today now.
All right. How can they call that a championship without the United States in it, right? No. I had a student from Iceland a couple of semesters when we were still in school, and I used to tease him. I said, Iceland, you have 300,000 people. We have 360 million. We can't find 11 guys to play soccer. Iceland qualified for the World Cup and we didn't. Kind of embarrassing, right?
It's in the culture. It's in the culture there.
Yep, in the culture. Yeah, in Iceland, if a little kid sees a soccer ball, his genetics tell him to kick it. In America, the kid will pick it up and start running with it.
Uh,
Got to work that out. I just wanted to say hi, Andrew. Nice to have you aboard. Hi, Tommy.
Hello, sir.
Were you able to keep up with the class, Tommy? You came in a little bit late, but I think you're okay.
Yes, sir.
Okay, just having a little trouble. All right, we'll call it a class, guys. As you know, this lecture will be put up on Canvas in a couple of hours, and it will also be available on the Bob Smagula YouTube channel, where you can see lectures on everything I've done over the last couple of years. I haven't yet deleted anything. So if you sit through this discussion here and you want to see me doing it with a different set of slides, that would be up there. So, okay, I'll let everybody go. Thanks for being here. Hope to see you all on Friday, okay? Goodbye, bye.